All right, what's up guys? This is Scott here again with my next live trading video. Today is Friday, June 3rd, and that means right now we are about 2 weeks away from the June monthly expiration cycle, which is when all of my wheel strategy positions are going to expire. And unfortunately, most of those trades are looking really bad right now. So that's why today I'm going to be taking some action to manage them in order to avoid assignment at really bad prices, also to collect additional credit and reduce my risk on these trades. And just to add some clarity to a few of my new subscribers or viewers here, this trading account is my fake money account, which is still based on real-time stock and option pricing, but I spun this account back up about 2 months ago because at that point I wanted to begin showing all different kinds of strategies, defense tactics, management techniques, things like that. Right, and really the main reason for doing so is because my personal style of options trading, which I still do in my live money account separately, that is definitely not suitable for all traders and investors watching this channel. And also, of course, my approach is definitely not the only approach that works. I mean, for example, the wheel strategy here, in theory, is a great way to trade options and stock as well. But the issue with that strategy is that it only really works in bull markets. And so far in 2022, we have not been in a bull market. Right, so for example, as you can see here, this category is where all my wheel strategy positions reside. And so currently I have 5 positions on right now in Alcoa, Apple, FCX, Netflix, and Nucor. And like I was saying, with the exception of basically Netflix and Apple a little bit here, all my other wheel strategy positions are down pretty big so far this year. Right, the collective performance of all these positions together is still a loss of about $2,200. That's not very good. And same thing also with my poor man's covered call positions as well. I currently have 2 on in gold and SPY. And as you can see over here, there's a very similar story. The combined effect here is a loss of just under $3,000. That's not good. And then if you compare that to my positions up here, right, these are the trades I manage with my own technique of selling naked options and then either buying or shorting the stock to cover the contracts that go in the money, etc. As you can see here, at least with the ones I have listed or the positions I have on right now or took off today in MU, for example, just in the past 2 months since I spun back up this paper money account, every single one of these positions is up by a decent amount. Right, so basically all these P&L year to dates are really just going back to the past 2 months here. And so having said that, I'm definitely not trying to brag or boast by any means. All I'm saying is that this is pretty much the main reason why I've created my own unique trading style because, the wheel strategy, the poor man's cover call, the regular cover call, etc., all these other strategies that you see other YouTubers talking about very frequently, these approaches will only work in bull markets. And as I've said in previous videos, I do not think we're going to see a bull market anytime soon. But of course, if you still want to trade the wheel strategy or cover calls, poor man's cover calls, anything like that for the very long term, which is still a great way to do things, then this video should be very helpful for you because again, I'm going to show you guys how to manage these kinds of trades when things go very wrong. Now, real quick before we dive in here, in case any of you are interested in getting some free stock or quite literally some free money, I've got some very cool promotions and opportunities in the description of this video, so check them out. Right, for example, if you want $200 of free stock from Tastyworks or a bunch of free stocks from Webull, free money from SoFi, etc., then again, check out the links in the description of this video. And secondly, in case you're brand new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video below. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright, so now diving in here, and by far the worst wheel strategy position I have on right now is in AA or Alcoa. So this company here is involved in the production of aluminum, and right now I'm short 2 contracts, 2 put options basically, with a 75 strike. And overall, year to date, or basically in the past 2 months, I'm down on this trade by almost $2,000. That's not good. Reason being, of course, if we now come back to the charts, and we'll go to AA, and I believe it was on this day right here where I put on that position initially. I basically thought this trend line here would hold as support, and that Alcoa would bounce off that point and resume higher. But obviously, as you can see, I was 100% dead wrong. So again, with my put strike at 75 and Alcoa right now being at around 61, this is why I'm down on the trade by so much right now. Now, of course, with the wheel strategy, part of this approach does involve taking assignment on the stock if your put options do expire in the money. That being said, however, if your option is super far in the money, you run the risk of not only early assignment, but just any assignment whatsoever will make you buy the shares at a very, very terrible price. Right, so based on where Alcoa is right now, there is no way I want to buy shares of this stock at a price of $75 per share. That is way too far away from the current stock price for me. So therefore, the best way to manage this kind of trade is to simply roll out the put option contracts to the next expiration cycle. And depending on how far in the money your contracts are, you may actually be able to do this and change your strikes at the same time. Right, essentially, it might be possible to lower your strike in the next cycle to essentially follow the stock down lower. And therefore, if you do eventually get assigned on your put options, it should be at a much more favorable price for you. And moreover, on top of that, when you do roll out your contracts, you will collect additional credit, which you can use to eventually offset any losses, as well as reduce your delta risk on the trade. Which means that if the stock does continue to move lower from here, then your losses on the trade after rolling will be far less than if you simply took assignment by the expiration date and took ownership of the full amount of shares. So really, when you add all this up, there's a huge benefit that comes with rolling out your contracts and basically just being patient. And so now, if we come back to the monitor tab and go back to my Alcoa trade here, I'm going to right click and then go to create rolling order. And then I'm going to click on this option right here. And so now, as you can see here, that brings up an order to do two things essentially at the same time. Again, up top here in the June monthly expiration cycle, as you can see, my put options right now with a 75 strike are super, super deep in the money. And so in order to roll these contracts out to the July cycle, I have to buy back these contracts for a loss, but then I'm going to sell the exact same contracts, or perhaps if I can, change my strikes a little bit in the July expiration cycle right here with 42 days left to go. And I'm going to do so for more additional credit because options with more time left will always have a much greater value than options with very little time left. So now coming back down to this order here, we're going to buy back both contracts of my 75 strike put options in the June cycle. And then at the same time, I'm going to sell two new contracts in the July cycle, which is right here. And then as you can see here with the pricing, I can do so for an additional credit of almost $100 per contract. But before I send this order, let's see what happens if I try to change my strikes in the July cycle. Basically, I want to see if I can lower my strike and essentially follow the stock. So we'll click here, and I believe the best I can do in the July cycle is go to these 70 strike puts. Right, because real quick, let's go to the option chain and scroll down, and we'll unfold the actual July option chain and just verify that, yes, indeed, so far there are no strikes in between the 75 and 70 put options here. So that definitely is a bit unfortunate, and as you can see down below with this order, now if I were to do this, I would have to pay a debit of almost $300 per contract. So unfortunately, because my puts are so far in the money, there's not much additional credit I can even collect at all, right? Even if I keep the strikes exactly the same. So change it back to 75 here, right? But for example, if my strikes were, let's say, at the money, in which case currently Alcoa is at around $61 per share. So let's just assume for a second my strikes were actually around 60. I'll change them real quick. And there you go. Now you can see both put options here have a 60 strike, and the additional credit per contract has jumped all the way to almost $220 per contract. So ultimately, this is one of the unfortunate realities of the wheel strategy. If your put options are super, super far in the money, even trying to roll them out in time to the next expiration cycle, you will not collect very much additional credit. But of course, in such circumstances, there's not much else you can do. And so let's go back and change these strikes to 75 once again. And here we go. So again, unfortunately, I cannot change my strikes at all in the July cycle, but at least I can collect some additional credit on my trade here. Now the prices on these contracts are a bit wide in terms of the bid-ask spread, so I'll come down a little bit, maybe to $90, and see if I can get filled here. So lastly, we'll go to confirm and send in this order. And there we go, just got filled and price improved to 95. Awesome. And there you go. It's basically as simple as that to roll out your contracts and collect additional credit. So now at this point, this is my second roll I've done for Alcoa here, and my total credit has increased substantially. Right, so briefly here, let's go ahead and pull up the calculator real quick. And so initially in the May expiration cycle, I sold those contracts for the first time, the 75 strike put options, each for a starting credit of $450. And then when I rolled out those contracts to June, I collected an additional credit of $30. Not a whole lot, but still more than zero. And now this time by rolling to July, I collected even more credit of $95 per contract. So now my total credit per contract is $575. And in theory, I can just keep repeating this process over and over and over again, collect more and more credit until perhaps I have collected enough credit to buy back these contracts potentially for a very large debit if Alcoa never recovers, and still perhaps break even or make a small amount of money on the trade. Right, currently these July contracts are trading for about $1,450 a piece. And so if my total collected credit on each contract was around the same amount, then perhaps I might just want to buy them back and break even on the whole trade. But unfortunately, as you can see here, I still have a ways to go. And of course, also, there is a very real possibility that Alcoa could recover in the near future and go back above my put strikes. So again, with rolling here, all I'm doing is extending the duration of this trade, giving myself more time, collecting additional credit, and reducing my risk on the trade. So this here is how I personally would manage a wheel strategy position that is in very bad shape. But then for my other positions right now, which are doing not so bad, I'm still going to leave them as is. Right, so for example, with my Netflix trade here, let's pull that up. As you can see, this put option contract as part of my wheel strategy position on Netflix is currently out of the money. And I did already have to roll this contract once. Right, originally, I had sold the 200 strike put option in the May cycle. But then when I decided to roll it to June here, I was also able to change my strikes a little bit and move it down to the 195 strike and still collect additional credit. So again, with this trade here, there's no need to manage it at least yet. But if over the course of the next 2 weeks here until expiration, if Netflix or the entire market takes a huge nosedive, then at that point, I will roll out the contracts to the July cycle. But also that being said, if Netflix does move a bit lower over the course of these 14 days, and it stays roughly around my put strike, maybe a bit lower than that, then in that case, I would not mind taking assignment of those shares. And in which case, after that point, I would begin selling covered call options on my long stock, which of course is the second part of the wheel strategy. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want some free stock or some free money, then check out the cool opportunities and promotions in the description of this video. And also, if you have an interest in taking some very detailed classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.